All right， 如果我不知道现在会几个人起来看直播啦。不过我上一次7点半起床呢，应该是那个高中的时候。Yeah, so that's crazy, bro. 如果你现在直播室的话呢 ，you know, credit to you, credit to you. Good morning, good morning, guys. 如果你现在看直播的话，那你要不是疯子，要么就是你也有一件这个 Grab 的背心。I don't know what to say, bro, because this is crazy. 我预期呢是没有人啦，要不然就是说呢，要不然就是说，因为我有一些观众是美国的观众啊，要不然可能就是你是美国人这样子，要不然我想不到任何理由有人7点半会起来看直播啊。Yeah 你知道也是谁疯了吗？也是我疯了。Yeah， 因为我想说呢，不然就试试看呢、因为蛮好玩的、就跟他同步一下嘛。等一下他是什么啊？8点要开始 earnings call 了。Yeah， 我跟大家讲。大家早安！我跟大家讲，我刚起床，所以我什么事都不知道。我现在什么都不知道啊！我现在开始找资料跟大家一起看，好不好？所以有人跟我说什么惨喽，我不知道。我现在什么都不知道，真的。所以就一起看说不定没有惨啊，说不定有人在乱喊啊，对不对？Yeah, Jesus Christ！ 我先喝个水，我习惯早上通勤听你讲财经啊，你是美国人吗？向恒不是你说你是通勤所以你早上的时候会看我的那个影片是不是？我以为你说我直播，我想说哇靠，我是在哪个宇宙被雷炸醒了？真的假的你不要吓我！常有观众跟我说，什么什么完了，什么什么完了，然后我一看他靠跌3%，你不要吓我。晚点看朵林狗吧，晚点吧，反正今天不是朵林狗的事啊。我们今天很重要，要来跟他同步直播等一下那 earnings call 开始，我要带大家一起听我先确定一下我这个声音有开好，输出音效，我来输出一下什么个音效一下，我来随便播个东西，看它会不会有声音呢？我来等一下我的 YouTube。然后我随便放一个，哎呦，早晨音乐，不要，这感觉会侵权。你们应该听到声音吧？等一下就知道，没关系。Yeah，Holy shit， 好了我先分享荧幕啦。我现在先那个看一下到底发生什么事情，好不好 ？Again， 如果你刚进来直播的话呢，我很感谢。我不知道会有几个疯子进来，不过这个时间呢真的是非常的 crazy。Yeah, crazy, you know. Literally crazy. All right. 我没有偷卖股票。原来230个人呢。Jesus Christ， 230个人，所以这230个人都是那个 Grab 的铁粉吗？因为我想不到任何理由，除非你是疯的呀。Anyways, guys, again， 如果你刚进直播室的话呢，欢迎你。我刚起床，所以我现在什么事都不知道。我们现在看一下，Grab 看起来在盘后的股价呢是跌了一些啦。我们来看一下这个 Trading View， 我刚看的大概长这样。就是昨天收盘在这里嘛，然后财报出来了靠腰跌了11个百分点不过又慢慢回来了，所以so it's like 4%, 5%， 我重新整理一下 ，OK， 这样子，我再放大一点，没有所以昨天收盘在这里嘛，这个是已经夜盘了嘛，所以收盘在这里 ，OK， 然后现在到这里 ，Alright， 3.8%， so it's not too bad 啦。如果我们只看夜盘的这个收盘之后的 price action， 那 is not too bad。Alright， 所以如果它是跌什么20%的话，那maybe some things happen，yeah，but I mean。 你不可能说这个是什么太糟糕什么吧？你们不要早上起来吓我呀，这样很不够意思。OK， 不要吓我。Alright， 我现在早上起来那个心脏不够力。OK，so alright， 2趴多啊，我们来看一下财报，因为反正还有半小时嘛，因为我看这个是什么？我们看一下，咱们这个 Zoom 的会议呢是8 AM， 所以大概还有，我们看一下时间。哦，还有20几分钟啊！这20几分钟我们就来聊天了，那然后看一下到底是什么数字，因为我看 Seeking Alpha 还没更新啦，这个还没更新，所以我就看了一下外部的网站。我们看一下 Grab Holdings Limited reported fourth quarter revenue 906 million 了，906 million 只上了19个百分点了。OK， gross profits about 400 million 上了将近20个百分点。Alright 一定是有什么 miss the forecast, beat the forecast， 大家一定想看这个嘛，所以看一下。Alright， so revenue came in below the consensus estimated 960哦，所以本来预期960，然后你给他906， not that good。Yeah， 这个不太这个不太优秀啊，这个不太优秀。但是 Grab 有常常 miss the forecast 吗？好像有童华姐，你看一下。Yeah， 所以这也不是什么大新闻，因为 Grab 常常都 miss the forecast。Matter of fact， 他已经连续2个季度 miss the forecast。Yeah， 所以这不是什么大新闻。OK，revenue miss the forecast 是很常见的啊。如果你说 earnings miss the forecast 就比较少见，因为它过去12个季度只有1个季度有 miss the forecast。OK， and revenue 是常常在 miss the forecast for some reason。Alright， 我们继续往下看。Profitability 跟 operating 这个是什么？Income 都是 significant year-over-year improvement 啊，当然啦，因为这个年度本来就会大幅的，我说上个年度2025本来就会大幅的变好嘛，yeah， 然后 operating cash flow weakened substantially despite higher reported profit. Alright, so operating cash flow 变少啊，这个我可能要等它的 cash flow statement 出来，它有出来吗？我刚把档案都开起来，可是我还没看呢 ，yeah。Like this one， 它可能有出来，然后那我们等一下稍微看一下。反正结论就是呢 ，revenue missed the forecast，EPS beat the forecast， 然后 guidance 我不知道有 miss 还是 beat， 他这边好像没有讲哦。Yeah， 我说 what the hell is this？ 他没有讲 guidance 有没有 beat the forecast 啊，没关系，反正有 beat 有 miss， 那个不太是重点了。我们就 beat 跟 miss 呢带大家看到这里然后。Sorry， 抱歉，我刚起床，那个鼻音很重。刚起床啊。好，那我们来先看 presentation 吗？好，不然我们先看 presentation 好了。各位刚出来的热腾腾的And we still got like 20 minutes。OK， 20 minutes 就 earnings call 了啊。在这之前呢，继续跟大家拉赛看一下。OK，revenue各位这个是 Q4， 不是2025整个年度Q4 up 19% year-over-year growth。然后 adjusted EBITDA 本来预期是会上涨50个百分点嘛，这是本来的预期嘛。本来的预期本来预期是整个年度上涨50个百分点，所以我们等一下看一下。OK， 然后 on demand growth， 大家知道 on demand 是什么吗 ？on demand 就是它不算银行的话了。如果你是新朋友的话，虽然我高度怀疑现在场的各位可爱的疯子们呢，会不会有人是不认识 Grab？ 因为如果你不认识 Grab 的话，你根本不会来看这个直播 ，Yeah。But that's okay。假设你不是 Grab 的你不认识 Grab 的话，没关系。我跟你说 ，Grab 就是东南亚的 Uber 啊。它除了 Uber 之外呢，还有一个银行。那 On Demand 就是不算银行的营收啦。所以这也不是营收，这是 Merchandise Value。Merchandise Value 就透过这个平台呢 generate 的金额。OK， 不管你是卖了这个一趟车次，还是你是卖了一个 Uber E 点单的订单的那个金额啦。OK， 所以这个订单的金额呢，不算银行。上涨21个百分点 ，Alright， 然后 Free Cash Flow 成长到了76 million， 只成长了7 million，Alright， 所以这 Q4 的 Free Cash Flow 增长的比较奇怪一点点，我们还是要看现金流量表才会知道说到底是你的资本支出很多吗，还是什么状况 ？Alright， 这也是可能刚这个 report 提到的啦，就是它的 Profitability 成长的非常多，但它的这个 Cash Flow 并没有跟着成长。这个是个小小的让人家不喜欢的地方。好当然还是要看整个表才知道为什么啦。 好啊，整个年度的 revenue 成长20个百分点，然后adjusted EBITDA 成长了60个百分点啊，不错啊，就是它本来预计是50嘛，然后最后成长了60哦 ，so that's pretty good。好 ，adjusted free cash flow 出来了，在这个290 million， 增加了128啦。OK， 所以增加128的话，也是增长了，就表示说去年是这个100多嘛。所以也增长了可能好几十个 percentage， 跟 adjusted EBITDA 成长的数字应该是没有差很多啊，所以 free cash flow 跟adjusted EBITDA 成长的速度是差不多的。那我跟他说这个 adjusted 在哪里啦？因为你听到这数字可能就是说，是不是公司在作假啊？这个刚好相反，因为这个 adjusted free cash flow 是不算银行的存款，因为它这个 cash flow 如果有算银行存款的话，会多很多啦。他帮你把银行存款扣掉，就会变成这个 adjusted free cash flow。Alright， 所以它反而是比较公正的一个数字哦。如果你只看 free cash flow 的话，这数字会变很大哦。Alright， 反正你就可以理解，不算银行的那个存款啊，那它的现金流到底成长多少？128 year over year， 还是我们叫它小算盘呢？Yeah， 小算盘啊，不然我这样都乱算也不太好。OK， 所以去年会是多少啊？去年是162嘛，如果是用190去减的话 ，OK， 所以128。减这个162 ，OK， 所以它的 free cash flow 增长了将近70个百分点 ，sorry， 将近80个百分点，这个79，我算给大家看了。好，所以帮大家标记一下这个 up 了 79% 呢。我们要配合一下这个那个马来西亚那边的口音啦，毕竟这是那边的公司嘛。OK。So Q4 这个 GMV 增20个百分点 ，revenue 增17，这个刚都讲过了 ，so that's fine。我们可以稍微看一下 free cash flow， 只从69成长到76，alright， 这个就成长的比较少 ，yeah，for some reason。这个 reason 呢，等一下 earnings call 他们可能会解释，可能不会解释。我先跟大家说啊，因为我可能9点就要滚蛋了，因为等一下要赶高铁。如果9点他还没讲完的话呢，我也没办法，但应该不会讲那么久了反正我们就再看看。好这个是整个 group， 你看就是 free cash flow 成长了79我刚算79他算78了随便了所以78个百分点。Loan portfolio 成长了120个百分点，这是今年的这是去年 ，sorry， 去年整个年度的数字，这样120个百分点 ，so it's pretty good。然后 on demand 成长了21个百分点嘛。Partner incentives 成长了33个百分点这个我不是到这个那么喜欢啦。有一个我跟大家解释一下，我不喜欢的点是因为它超过这个 GMV 啦。就其实你的平台的整个成长速度没有那么快，但是你的incentive 是什么？大家知道吗？就是我做的一些奖励措施，比如说你来赶快来我这边使用 Grab， 然后我给你多少优惠，这个叫 incentive。OK， 那这个33超过平台增长数字嘛，所以我不喜欢嘛。但是你看consumer incentive 只增长了17个百分点，所以它其实是比平台增长速度更慢的。Alright， 那 consumer incentive 就是我刚讲的，你赶快来做 Grab 的车子，你赶快用 Grab 来订那个餐点，那我给你多少优惠？这个是给消费者的这个福利这个福利算是公司的成本嘛所以算在这里。它其实并没有给消费者这么多的福利所以它福利都给去哪了？福利是给到 partner 上面，因为东南亚那边非常缺司机啦，你也可以理解成说它的 demand 非常的不错，所以它需要更多的司机，所以它需要更多的奖励措施在司机上面，所以它是用在自己的 let's say 不太算是员工，不过算是合作伙伴上面。所以如果是反过来 partner incentive 17%， consumer incentive 33% 的话，那我会更讨厌但如果是现在这个状况的话，我还可以接受。OK 只希望这边大家有听懂。大家铁定听得懂，因为大家都比我聪明。I know， yeah。cash 这个没有讲到 cash flow，alright， 所以我这边就直接跳过。我现金没有问题就是现金一直有人在存款嘛，所以如果你只看现金的话，当然没有问题，因为存款的人一直越来越多这个 time deposit 有没有？没有变多，不过一直有很稳定的人在存款。OK，so 现金变多，那 liabilities 应该也有变多啦。loans and borrowings，OK， 所以他借出去的钱也变多了所以这个其实 没有到非常有参考价值，因为只要一直有人在存款，你这个现金就会越来越多。Alright， 可能等一下需要看的是现金流了。我们还有13分钟可以讲解啊 ，That's OK。如果讲解没完的，就等他 earnings call 结束之后再来讲解。也有一种可能就是他迟到，有没有？也有可能就是8点，然后主持人还没进来啊，那没办法。Q4 的 on demand 21嘛 ，Yeah， 然后 adjusted EBITDA percentage of revenue，OK， 这就是你的 margin 啦，你的 EBITDA margin， 你的 EBITDA margin 从去年的 12.7%， 然后到现在是 16.4%。这个是整个 group， 包括银行，所以你可以看到它的 profitability 相较于1年前有很显著的提升了。然后 deliveries 就是 Uber E 的部分 ，Uber E 的部分 GMV 的 margin 就是它的 revenue 它的 EBITDA 除以 GMV gross merchandise value，OK， 是 2.2 个百分点。那这个数字管理层是说有机会 maybe possibly 可以到3之类的 ，Yeah， so 2.2 不是最高啦，就还有机会可以更高啦，只是也比去年好一些了 ，Yeah， 然后是 year over year 成长47个百分点 ，that's OK，Yeah， 好，然后 mobility 就是 Uber 的部分，在客人的部分呢成长了20个百分点。成长20个百分点 ，gross merchandise value 的话，成长20个百分点。然后 adjusted EBITDA 是 margin 变成 8.6%， 这个就比较稳定啦，因为这两个部门都已经有在盈利了今年就是希望说它的这个 financial 可以转正嘛，所以看这边都还好啦。管理层说这个部门的稳定的 margin 应该是 9%， 所以这个还可以再更高一点啦，也行了，主要是这个 financial services 什么时候可以转正啦，所以这个季度它的贷款量呢又暴增了120个百分点嘛，revenue 是成长了34个百分点，所以也是那3个部门成长最快的重点是你这个可不可以上来这个逆水线以上 ？OK， adjusted EBITDA 的 margin 是有 improve 了，从负36%变成负25%。OK，so 如果今年要转正的话，它不能用这么慢的速度去转正应该要更快所以就看管理层怎么讲有没有要往 break even 靠呢也是有啦，也是往右上角啦，所以乍看之下是 OK 啦 ，OK incentive 刚看过了，就是它主要应该是还都是花在 partner 上面，不是花在 consumer，right？ So partner incentive。这个 4.1% 是什么 ？Partner incentive 这个是金额啦 ，a million 这个是金额 ，OK， 然后这个也是金额，然后 total incentive 是这边2025，然后相较于2024，大家可以自己算一下数学我们再看下面，它很贴心的提供了这个 percentage of GMV， 结果这个平台交易量有多少%是拿去做这个奖励措施的。好，所以 consumer 的部分 5.7% 的 GMV， 相较于去年它是有 6.1% 的 GMV 拿来做 incentive， 现在变 5.7% 嘛 ，so that's good。但是去年的 partner incentive 是 4.1， 今年变 4.7， 变多了所以它等于是把 consumer 这边扣掉拿去给 partner 了。所以 total 它的 incentive 呢并没有变少，还变多一点，从 10.1 变 10.4， 这个数字不能一直上去了。所以管理层之前也有提到过，这个数字已经差不多就这样了，就是不太可能再有激增的状况大概就是10%出头的 total GMV 是紧绷了因为他们 marketing 需求很大，所以也不预期会下来但是如果没有一直上去的话，那还 OK 目前看起来从 10.1 到 10.4 嘛就还可以接受这样子如果它一直上去，比如说变成15、20，那就是有点失控这样就不行。好 ，OK 我还没看到 Outlook， 现在看到了 Outlook 2026的 revenue， 他跟你说 20% 到 22%， Adjusted EBITDA 预计会成长 40多个百分点，好像没有很糟呢。我感觉没有很糟因为 Grab 是会突然拉高自己的那个 guidance 了。OK， 所以他今年成长20个百分点嘛。今年成长20个百分点，然后去年成长20个百分点啊。2026跟你说我20到22，所以应该要是有加速成长啊。So it's not that bad。那我来看，我再来看一下 price action。Yeah， 哎呀，又稍微偷偷摸摸上来一点点，有没有？又偷偷摸摸，刚是看跌3点多趴嘛，现在也是啊，反正就差不多这样子。Alright， 差不多3点多趴。所以这个可能是 revenue miss 有点多啦，就是2025第4季 revenue miss 有点多，要不然这个 outlook 也好像还好，还行呢。在哪里 ？Yeah， 因为到时候假设它又有，比如说未来1月、3、4个季度又有一个季度会给你稍微提高一点点的话，所以你最后成长可能会落在22%左右。你最后成长落在22%的话，就比2025高了呀。所以说 it's not that bad 啦。然后 adjusted EBITDA 又可以成长44%。等一下听管理层怎么讲吧，看他会不会讲说确定今年 financial 会转正了。Yeah。不然就是他觉得44%太少，因为今天3个部门都转正了啊，你只有44%的增长，他觉得不够，有没有可能会这样？有没有可能？也是有可能 ，Yeah。不过如果只看这个 outlook 的话 ，22%、44% growth ain't that bad. To be honest, okay, ain't that bad. 好，然后还有这个 3-year outlook 啦 ，3-year outlook， 哎呦，新招哎，这个我现在都在开讲，因为这每一页我都没看过啊。OK， 新招。20% CAGR 未来3年，还不错啊。然后2028的 Adjusted EBITDA 是 1.5 billion。然后2028的 Adjusted Free Cash Flow Conversion 是 80%， 哎，好贴心哦。因为我们最担心的就是说，哎，你这个 Free Cash Flow 是跟 EBITDA 转换率是多少？可以1:1吗？还是1比 0.5？ 不知道。呀，而且跟你讲 Conversion。就是我的 1.5 billion 的有 80% 可以变 free cash flow， 他是这样讲吗？我猜是啦，我们放大一下看一下他这个解释是什么。Free cash flow conversion are non EBITDA and just free cash flow conversion， 对啊，所以它就是 1.5 啊，然后乘以 80% 嘛，乘以 80%。OK， 所以就是1.2 billion 的 free cash flow 2028年。而且是 adjusted free cash flow，adjusted free cash flow。OK， 那很好啊，那我们就可以来看到时候应该要长怎样嘛。其实这样就蛮好算的啦，因为 1.2 billion 的 free cash flow 啊，那你觉得这个 on demand 的，就是这2个部门呢、啊？因为这不算银行了嘛，就是 Uber 跟 Uber E 这2个部门 1.2 billion free cash flow。你给他随便乘个倍数，随便乘呀，比如说25倍啊，就25倍的这个 price to cash flow， 等于说本益比的意思啊。OK 啊，所以这个乘下来呢是多少 ？1.2 乘25啊，数学不太好，哇塞，25加5 30，是这样吗？应该是。好，假设没有算错的话，30 billion。30 billion 是它的这个什么啊？这2个部门的 market cap 了啊，我不太知道它现在多少来哦，现在 market cap 是17 billion 啊，今天肯定会跌一点嘛，所以大概是17、16 billion， 不知道呀。几点了？我看一下时间了，我很怕错过。很怕错过，然后我起来一个寂寞，然后只带大家念了几个数字，然后那个 earnings call 没听到，我会爆气了。Yeah， 好，所以17 billion， 现在17 billion， 你说我们2028年2个部门假设30 billion 啊，再加一个银行，随便加个5 billion 好了，35 billion 啊，那个 double 嘛，啊，所以2028年可以 double 的话，好不好？啊，是当然很好嘛 ，Yeah。啊，当然啦，这个是前提，它可以达到这些数字啦。啊，如果它达不到的话，当然就什么都不用谈嘛。 如果达得到的话，我只能跟你说，现在4块的 Grab 很便宜嘛，因为它2个部门就可以 double 了再看第3个部门对啊，就这样嘛如果达不到的话，就什么都不用谈了，没有达不到的话，就笨蛇呀如果达得到的话，现在的股价贵吗？现在的股价就不贵当然你也可以说这样的部门不值25，那你就自己算，比如说1.2 25太多乘以20那你的 target 就是24 billion。2个部门24 billion 你再给他加第3个部门，就是那个银行部门比如说在5 billion， 那它就是大概30 billion。OK， 所以你可以自己调整这个倍数啦，要不然你也可以拿这个 1.2 去做 DCF 就是那个现金流折现法，你可以自己做做看。OK， 反正这个长期的 outlook 给大家参考，因为这也是他之前没有提到的东西，就是新招。OK， 好这边的是什么这边是那个他怎么算 adjusted EBITDA 的，算给你看。好不好？所以他的 profit 153嘛，他 adjusted 只有148也没有坑你啊，OK， 年度的话可能有烧坑啦，因为年度的话有什么情况？为什么是录制中啊？我没有在录制啊。为什么在录制中啊？那谁可以解释一下现在什么情况？因为我很久没用 Zoom 了啦。靠腰我带，还是我再重新进来一次 ？OK， 离开离开会不会进不来了？完了，我现在好多那个，我觉得应该是他们还没进来，对不对？It should be 传送至会议室。好，传送至会议室会怎样 ？Yeah, what the hell is this shit? Yeah 没有，因为我还要什么金钥？我进去会不会就变 management 啊 ？OK，so what the hell？ 好不然我们再点一次，从 Zoom join from browser。OK，join from browser， 我们再 join 一次。我的名称Nick， 好，加入。Okay, we are in. We are so in. 好，那 Zoom 应该就先不用理他了，因为我们是从我们我先确定一下，你们现在听得到他音乐吗？不能调声音哦，搞笑哦。OK， test 1 2 3。OK， 好，我看一下你们留言好了，你们先看得到吗？你们听得到他的那个音乐吗？他现在有那个播放前的音乐。很活泼的音乐。OK， 那好。楼上兄弟怎么了？顺便看一下你们的。
Good morning and good evening, everyone.
谢谢开始。
Thank you for joining Grab's fourth quarter
我就不讲话了。
2025 earnings call. I'm Ken Leck, Head of Strategic Finance and Investor Relations, and joining me today are our co-founder and CEO Anthony Tan, our Group CFO Peter Oye, and our President and COO Alex Hungate. Now, before we begin, please note that we are going to be making some forward-looking statements today. You should not place undue reliance on these forward-looking statements, and actual results may differ materially from these statements. And we do not undertake any obligation to update any forward-looking statements we make today, except as required by law. We're also going to be presenting both IFRS and non-IFRS financial measures. Please see the supplemental slides and our earnings release for more disclosures about these non-IFRS financial measures, including a reconciliation of IFRS to non-IFRS measures. We're doing things a little bit differently today, and many of you would have seen the detailed investor deck we published on our investor relations website, and also the video format to our earnings. Today's session will begin first with a 45-minute presentation from our management team, followed by a Q&A session where we do encourage all of you to submit questions via email throughout the presentation to investor.relations@grab.com. And with that, I'll now turn it over to Anthony for his opening remarks.
Thanks, Ken. Good day, everyone, and thank you for joining us. In 2025, Grab delivered its first full year of net profitability, while accelerating GMV growth to 21% year-on-year across mobility and deliveries. This represents our highest growth in recent years as our team executed upon our product-led affordability strategy. This resulted in strong user growth and engagement, which has improved user lifetime values. Today, I want to take a step back and talk about why this business now compounds, how our journey over the past 4 years since going public fits into that story, and how we think about the next phase of value creation through 2028. Let's start with a few milestones to explain what they represent. When Grab went public, one of the most common questions we heard was, could this business ever be profitable at scale? Since our IPO, Grab has now crossed over 20 billion rides and deliveries, doubling from our first investor day. We've delivered 16 consecutive quarters of adjusted EBITDA improvement. We've achieved our first year of adjusted free cash flow in 2024, which has now doubled to 290 million in 2025, while we generated $200 million of net profit for the year. Along the way, we expanded our horizons. We launched digital banks in Indonesia, Singapore, and Malaysia. We crossed 1 billion in loan portfolio and achieved our first major milestone with our Indonesian bank, Superbank, going public in an Indonesian stock exchange in December 2025 that was oversubscribed 318 times. These are not isolated achievements. They're the outcome of a platform that's beginning to reach escape velocity, where scale, discipline, and product depth reinforce each other. Today, we've expanded our ecosystem to having over 129 million annual transacting users with Grab. 47 million transact monthly, growing 33% from 2023, and 7.8 million transact daily. In particular, monthly transacting user to annual transacting user conversion has grown to 37%, and in the years to come, you'll see us driving further conversion of our daily transacting users to monthly transacting users from the 17% today, which is actually the key opportunity as we increase the depth and the affordability of our services. This matters because users who engage across mobility, deliveries, and financial services stay longer, spend more, and are meaningfully cheaper to serve over time, particularly as we amortize their acquisition costs over multiple segments. We talked about users. Now let's talk about product. When we first came up with the concept of the super app, we focused on breadth, but not so much on depth. What we realized early on was that while users were trying our new services, the level of stickiness was still lacking. The product was not customized to their individual preferences. Fast forward to today, we've expanded our product suite multifold and deepened our focus into the core categories: transport, food and mart, and financial services. Take mobility, for example. we now have low-cost transportation options, but also executive services catered to corporates and travelers. At the same time, we have also integrated maps as well as family accounts, which provides more options even for teenagers to book a ride. As a result, customers no longer need to go elsewhere because they know we cater for different needs across the week. This has been a core tenet of driving user growth and engagement in a profitable manner. This is how we drive growth re-acceleration in our business, where Grab today serves 1 in 15 Southeast Asians monthly, up from 1 in 20 just 3 years ago. More importantly, approximately 2/3 of our users now use 2 or more services on our platform. GMV growth has also significantly re-accelerated, where we have achieved our fastest growth since 2022, and we are far from done in our growth journey. The newer users we have acquired continue to demonstrate a similar level of quality when it comes to their spend levels relative to our older cohort. They're already increasingly sticky the longer they remain on the platform. Once you reach this level of density, growth stops being linear. It becomes self-reinforcing, and as we introduce more new products in the years to come, the ecosystem will compound further. I am confident that we'll be able to sustain this growth momentum in the years to come. One call out I'd like to make is on group profitability. We have come a very, very long way to arrive at where we are today. We made tough decisions on business to optimize, and we spent hours with the team building a monetization engine across our various segments and set the bar high on talent and overheads, all while driving growth acceleration at the same time and improving our category position across the region. You see here on the slide the fruits of our labor, where we have demonstrated our ability to deliver consistent EBITDA improvement, generating our 16th straight quarter of adjusted EBITDA improvement, closing the year with continued momentum across growth and profitability. What matters here is not the slope of one quarter. It's the fact that incentives are no longer the primary driver of demand. Margins are expanding through operating leverage, not cost deferral. And cost discipline is now embedded in how we operate, not imposed after the fact. But the journey is far from over. We intend to continue driving profitable growth in the years to come. We do this while continuing to keep an eye sharp on the future, where we will be investing into AI as well as autonomous vehicle and robotics technologies, which Alex and Peter will share more in their sections. The growth and profit acceleration we have driven today is a direct outcome of the strategy that we shared with you 1 year ago. And looking forward, our strategy will continue to be driven by the same 3 key pillars. We're focused on affordability and reliability to widen the TAM of our audience and provide customers with a delightful experience. Secondly, deepening engagement within the ecosystem through product-led lens. And third, leveraging technology and AI to unlock efficiencies across the platform. Alex will go through in greater detail each of these priorities later in his section. That brings me to how we're thinking about the next 3 years. Based on the trajectory of the business today, we are introducing a clear, long-term framework through 2028. From 2025 to 2028, we expect to drive 20% CAGR in group revenues, driven by deepening our penetration across our affordability and premium segments, improving monetization of our business, and increasing contributions from financial services. Adjusted EBITDA of $1.5 billion as a result of the growth we achieve coupled with operating efficiencies we drive across the business. And then adjusted free cash flow conversion of 80%, improving from 58% in 2025 as we continue to optimize efficiencies around capital expenditure, working capital, and tax. These targets are not aspirational. They're the logical outcome of the scale we've already built, the operating leverage already visible in the model, and the discipline we now apply to capital allocation, which Peter will share more about in his section. In closing, Grab exits 2025 as a very different company than the one we founded 14 years ago and to the one that went public 4 years ago. In our founding years, we proved that ride-hailing and delivery were real businesses. In the second era, post-IPO, we proved our business model, that we could be profitable and sustainable. And now in this third era, I'm determined to prove our long-term vision, that we can indeed continue to innovate, lean in on AI-first technologies, and become the platform of choice across the region while empowering our driver partners and merchant partners with heart. I feel more invigorated today than I did when I started this business, and together with all our Grabbers, driver partners, and merchant partners, I am confident that we can continue to execute towards our triple bottom line in the years to come, generating profits, uplifting millions while improving ways to serve in a more environmentally friendly way. With that, I'll hand it over to Alex to walk through how this strategy is translating into execution on the ground.
Thank you, Anthony. Anthony has set the vision for where we are going. Now I will go into the details of how we plan to get there. The growth acceleration we have driven today is a direct outcome of the strategy that we shared with you a year ago. And as we look ahead to the next 3 years, we are doubling down on this same strategy because we see that it is working, and we believe that it is difficult for our competitors to respond. We are focused on affordability and reliability to widen the addressable market and provide customers with a delightful experience. Secondly, deepening engagement within the ecosystem to improve customer lifetime value. And third, investing in technology to translate increased demand density into greater operating leverage. Today, I intend to update you on how we have been executing upon this strategy, and then share our plans of what we plan to do next in each priority. So let's start with affordability. For me, this is a magical slide. Just look at how we've been able to reduce the fares for passengers by 16%, while simultaneously improving driver earnings by 29%. This may sound counterintuitive to most, but it is the holy grail for on-demand platforms, because it demonstrates that we can successfully leverage our tech to allow drivers to complete more trips in less time and improve their earnings without relying on higher fares. It is extremely difficult for smaller competitors who lack our network density and tech investments to keep up with this improvement in price performance. The remarkable thing about Southeast Asia is how many big cities there are and the sheer density within these cities. Bangkok, Manila, Jakarta, for instance, all have a population of over 20 million, with a density that is perfectly suited for the ride-hail business model. In the earlier years, Grab grew mainly within these capital cities. Now, with Gen AI capabilities that we've developed, we are able to capture the undertapped opportunity beyond these capital cities. Today, we operate in almost double the number of cities that we did in 2021. And GMV in non-capital cities is growing over 2 times faster than in capital cities. So, as you can see, there is still tremendous upside in the growth potential in the cities of Southeast Asia. Our affordability strategy has also accelerated. GMV growth in deliveries is growing faster and more profitably than our peers in the region, thanks to our laddered pricing strategy and viral product innovations. Our Grab food customers are enjoying the perfect trifecta of better affordability, selection, and service quality today. We lowered the delivery cost per order by 8% since 2021, which has helped to drive a 41% increase in food transaction volumes. Merchant selection improved at the same time, 25% over the same period. And fulfillment service reliability has also improved by 3 percentage points in the past 3 years. Next is maximizing ecosystem value. The intent here is to grow the lifetime value of every user who joins us. We are focused on driving users into new categories and expanding how they use our platform every day. Every interaction is an opportunity to deepen their loyalty and capture more value across our entire business. We are cross-selling services to more of our user base every year. Today, approximately 2/3 of our MTUs use 2 or more services. We are also driving higher spend and frequency across user cohorts. Our 2021 deliveries cohort transacts 1.5 times more often relative to their first year, while all post-COVID deliveries cohorts demonstrate higher spend of up to 1.6 times relative to their initial year. To drive this engagement, we have built a powerful loyalty flywheel, combining 3 components. First, Grab Unlimited, the largest paid on-demand loyalty program in Southeast Asia, which now accounts for 35% of our deliveries GMV. Next, Grab Coins, our rewards program recently redesigned as an ecosystem currency to nudge cross-sell behaviors. And lastly, Grab VIP, an exclusive program reserving the best service quality and exclusive perks for our top spending users. Southeast Asia is becoming an increasingly popular travel destination. To capture this opportunity of growing demand, over the past 2 years, we have struck partnerships with regional airports, acquiring visitors from the moment they land. We have also embedded in-app translation features, leveraging large language models to overcome language barriers. And we have integrated with global partners like Trip.com and Alipay to enhance brand visibility even before users land in the region. And as a result of these initiatives, travelers' MTUs have grown over 10 times over the last 3 years, with airport rides driving over 10% of our mobility GMV today. GrabMart is growing 1.7 times faster than GrabFood, thanks to 3 important improvements to the customer proposition. First, deepening integration with major supermarkets to ensure that handling of fresh produce deliveries is reliable and consistent. Next, curating our merchant selection to shift user behavior from daily essentials to weekly stock-ups. And lastly, Grab More has been launched, where users can add groceries to their food order at no additional cost. And as a result, we've seen a 30% year-on-year increase in GrabMart users in 2025, while usage frequency continues to improve. There is still plenty of upside with GrabMart, only accounting for 10% of our deliveries GMV today. The success of our merchants has always been at the heart of our mission. The powerful integrated suite of offerings that we've built for them is intended to take them and the Grab platform to the next level. First, Grab offers merchants enterprise-level digital tools that help them maximize their return on advertising spend. Next, we provide integrated point-of-sale and payment systems to widen payments acceptance for them. And then we embed lending to improve cash flows. And finally, transform their transaction data into actionable insights to help them scale their businesses. With these capabilities, Grab will be able to deliver the one outcome that matters most to our merchant partners, which is, of course, sustained earnings growth. In 2025, total active deliveries merchants increased 9% year on year, while their earnings have seen a corresponding increase of 11%. Our financial services strategy is centered on embedded distribution that lowers customer acquisition costs with personalized offerings. For the majority of our users, drivers, and merchants, GrabPay is their initial entry point into our range of financial services. And as they build a transactional history with us, we can also offer lending and insurance and even digital banking services in Singapore, Malaysia, and Indonesia. In just 3 years, we have grown to 7.4 million deposit customers across our 3 banks. We have not had to invest heavily in acquiring new users or offering high deposit rates, as we are converting the users who are already on our platform. This also drives our lending business because we see high-frequency daily transaction data on our platform. We can predict risk more accurately, and this allows us to scale our loan portfolio rapidly, while risk-adjusted returns continue to track above our cost of capital, and credit costs remain well within our risk appetite. In 2025, our gross loan portfolio surpassed $1 billion for the first time, ending the year at $1.3 billion. Our goal is to exit 2026 with a gross loan book of over $2 billion. I also want to touch on this morning's announcement on our acquisition of Stash, a US-based digital investing platform. While we remain firmly committed to Southeast Asia and the growth of our regional lending business, this acquisition achieves 2 specific objectives. First, it accelerates our wealth management roadmap with the addition of new capabilities and talent. And second, it has an attractive financial profile. Stash has the potential to grow into a high-margin subscription revenue stream, contributing over $60 million in adjusted EBITDA by 2028. The last part of our strategy is potentially the most important for the long term. That is how we harness technology, including AI, for efficiency gains. We leverage AI to improve conversion at every stage of the funnel. For example, we automate menu translations to enhance conversion of high-value segments such as travelers. Over 97% of our merchant listings regionally are now available in English and Chinese. Our credit scoring models are also increasingly robust, as we were able to whitelist a greater proportion of ecosystem partners. We have also improved real-time personalization by collating a database of over 1,000 attributes and segmenting our users and ecosystem partners into 200,000 distinct segments. And finally, we have improved our search and basket conversion with AI semantic search and real-time personalization. Our tech investments are helping us to gain operating leverage. We continue to lower our cloud costs per transaction by proactively retiring idle resources and transitioning to more cost-efficient solutions. And at the same time, payment processing costs as a proportion of total payment volumes is declining as we increase volumes through our wallets. And finally, we are maximizing headcount efficiency by deploying in-house AI models. For example, you may be asking yourselves, how are we able to double the amount of cities in which we offer services with a reduction in operations headcount at the same time? The answer is that we have been deploying auto-adaptive technology to optimize our core marketplace in each city, enabling us to scale in a lean and agile fashion. In fact, today, more than 90% of our mobility rides are dispatched by using AI. Looking ahead to the future, we are investing in the next structural shift in on-demand services, autonomous vehicles and robotics. In partnership with WeRide, we launched our first AV shuttle service for the public in Singapore. Our position as Southeast Asia's leading on-demand marketplace makes us the preferred commercialization partner for global autonomous technology leaders. We are committed to serving two critical functions. First, acting as a key thought partner for regulators to help define safety standards and operational frameworks for driverless transport. And next, supporting our driver partners through the transition to a hybrid fleet by uplifting them to take on specialized roles in safety and fleet management within the autonomous ecosystem. So in closing, I have updated on the strong progress we are making as we execute towards our strategy and shared with you our priorities for the future. We will work closer than ever with our merchant and driver partners, government agencies, corporate partners, and grabbers to execute this strategy. Thank you for your continued support. And with that, I will now turn the call over to Peter, who will discuss how these developments support our financial roadmap over the next 3 years.
Thanks, Alex. Anthony and Alex have just laid out a powerful strategic roadmap focused on affordability, ecosystem-led lifetime values, and Gen AI efficiency. I will now show you how that strategy is translating into our financial roadmap, which is driving durable, profitable growth at scale. Now, what makes it particularly energized is how our execution over the past few years is already setting the foundations to drive the financial outlook that we are setting today. Let me first deep dive into our fourth quarter and 2025 results, which sets us up for the next chapter of our financial roadmap. We delivered a strong finish for the year in the fourth quarter, characterized by product-led, demand-driven growth. Our on-demand GMV increased 21% year over year, or 20% on a constant currency basis, with transactions outpacing GMV growth at 24% year over year. The strong volume growth is underpinned by our affordability and ecosystem expansion strategies that drive both user acquisition and also drive higher transaction frequency. Our group revenue grew 19% or 17% year over year on a constant currency basis to $906 million. This is fueled by this GMV momentum and also driven by increasing contributions from our financial services. Now, financial services also achieved our goals with our gross loan portfolio hitting $1.3 billion and our net loan portfolio reaching $1.2 billion, well above our guidance of $1 billion, all while maintaining healthy risk-adjusted returns. Adjusted EBITDA reached $148 million for the fourth quarter, marking our 16th consecutive quarter of EBITDA expansion. On a full-year basis, adjusted EBITDA grew by 60% year on year to $500 million. This profitability is being powered by our robust top-of-the-funnel growth and also our relentless focus on driving operating leverage as we scale. Finally, we generated $76 million in adjusted free cash flow for the quarter and $290 million for the full year, underscoring the efficiency of our platform. The scalability of our ecosystem is delivering a clear trend of accelerating top-line growth, coupled with expanding profitability. And when we take a step back to review 2025, we hit several key milestones. Let me show you what they are. First one, we have driven a strong acceleration in growth, with on-demand GMV growing by 21% year over year. We are able to do this as a result of years of effort to widen the top of the funnel and execute on the product-led strategies Alex just described. Our confidence in this momentum remains high because we are seeing our product-led and ecosystem-focused initiatives drive higher transaction frequency and also attract a broader user base than ever before. Now, as we continue to scale the ecosystem, it translates into operating leverage as we benefit from greater network scale efficiencies. From our first quarter of adjusted EBITDA profitability achieved in the third quarter of 2023, we subsequently recorded positive adjusted free cash flow for the full year 2024. And I'm also proud to announce that in 2025, we achieved our first full year of net profit. As we look ahead, there are 4 core principles of our financial roadmap that will guide our execution in the medium term and serves as a framework for how we create long-term shareholder value. Firstly, we remain focused on growing in a sustainable and durable manner. We're not chasing growth at any cost. Instead, we are driving relentless improvements to the affordability and reliability of our core offerings to capture a larger share of our addressable market, and also employing that product-led and ecosystem-focused approach to cross-sell high-margin services like financial services. Secondly, we will continue to drive improvements to operating leverage. Our priority is now to build on this foundation and compound the earnings growth of our ecosystem as we continue to benefit from the network efficiencies we've spent the last decade building. Third, we are laser focused on free cash flow conversion. We expect our adjusted free cash flow conversion rates to improve as our profitability grows and achieving operating leverage. Finally, we will maintain a strong, disciplined balance sheet. Our capital allocation framework is one which prioritizes organic growth with high returns, a remaining discipline on M&A while returning excess capital to shareholders. Now let's look at how this all comes together in our guidance for 2026. First, on the top line, we expect group revenues to grow between 20% to 22% year over year to $4.04 and $4.1 billion, accelerating from the 20% growth in 2025. This is not just a byproduct of a larger base, it's a direct result of our sustained growth in our on-demand GMV and financial services continuing to be our fastest growing segment as we scale our loan portfolio. Now, on adjusted EBITDA, we expect to grow by 40% to 44% year on year, reaching $700 million to $720 million in 2026. This step up in profitability reflects that network scale efficiencies and cost leverage we've been building into the platform. This is supported by the continued growth in our on-demand EBITDA, but also financial services segment moving towards EBITDA break-even in the second half of the year, as we continue to lean into technology and Gen AI also to drive the corporate efficiency and the operating leverage in the business. Now, I would also like to outline how we are thinking about the next 3 years and the goals we are focused to achieve. For the next 3 years, we expect robust momentum in revenue, growing at a 20% CAGR from 2025 to 2028, with adjusted EBITDA tripling from 2025 to reach $1.5 billion in 2028, and for adjusted free cash flow conversion to expand to 80%. Now, let me discuss each of these in the next 3 slides. Looking ahead through 2028, our revenue outlook is defined by a demand-led strategy across several high-velocity levers. First, for our on-demand segments, we are very focused on new user growth by expanding our footprint into non-capital cities, while broadening at the same time our product suite to capture the untapped segments of the market. This expanding base gives us a larger foundations to drive retention and frequency. And furthermore, we expect a gradual increase in basket sizes. Secondly, our financial services engine. We expect financial services to become an increasingly larger contributor to our total revenue base. By leveraging our proprietary ecosystem data, we can scale lending dispersals with high confidence in our credit costs, creating a high margin revenue stream. Finally, on MSME and merchant solutions, we see significant upside from merchant-focused initiatives, specifically in advertising and omni-commerce solutions like Dine-in. These are services that allow us to enhance our value proposition to merchants. Collectively, these strategic pillars provide a clear trajectory towards our 2028 revenue targets. Now let's move on from revenue outlook to our EBITDA trajectory. Our focus is on driving operating leverage required to reach our target of $1.5 billion in adjusted EBITDA by 2028. Now, to put into context, this represents 3 times growth from our 2025 performance and a more than doubling of the EBITDA we've guided for 2026. This is anchored by 3 key pillars. First, on demand. Our primary driver for absolute EBITDA growth is the expansion of our top of the funnel. As we continue to expand this ecosystem, we are benefiting from compounding network scale efficiencies, particularly within fulfillment and fixed cost leverage. This enables us to track towards our long-term steady state margins of 9% plus for mobility and 4% plus for deliveries. Secondly, for our financial services, we are firmly on track to achieve EBITDA break-even in the second half of 2026. And from that point onward, we will progressively expand margins. This transition will be fueled by the scaling of our loan book and the continuous maturation of our credit models, which allows us to grow interest income while keeping a tight lid on credit costs. Finally, on corporate costs. While absolute corporate costs will naturally increase as we scale, our focus is on driving operating leverage and ensuring that these costs grow at a significantly slower pace than group revenue. By executing across these 3 fronts, we will aim to become more efficient as our business scales. As we scale both our top and bottom lines, we are entering a phase of accelerated free cash flow growth. The key takeaway here is our conversion efficiency. We expect our adjusted free cash flow conversion to move from 58% in 2025 to a target of 80% by 2028. This is driven by capital expenditures and taxes growing at a much slower rate than EBITDA. While we remain disciplined in how we deploy capital into critical assets like our fleet, including autonomous vehicles, we're also aiming to decouple our revenue growth from our capital intensity. This ensures that even as we invest for the long term, we are seeing a much higher portion of our earnings converting directly into cash. By 2028, we expect this efficiency to generate over $1.2 billion in full-year adjusted free cash flow. This level of cash generation allows us to self-fund our continued innovation while maintaining a strong balance sheet. Finally, I want to discuss our capital allocation principles. As we move into this next chapter, our framework continues to be anchored on 4 priorities. First, we remain disciplined in investing for organic and profitable growth. We are ensuring that our core segments have the resources needed to capture the deep market opportunities that we see. And also, we'll be prudent towards deploying capital where it generates the highest returns. Second, we are staying highly selective on inorganic opportunities. We will maintain a high bar and only pursue acquisitions if they strategically accelerate our roadmap, bring in critical technology or talent, and meet our strict return thresholds. Third, we'll aim to maintain a strong balance sheet with ample liquidity. Our robust cash position is a competitive moat. It ensures we can navigate macro volatility with ease while continuing to innovate. And finally, where we have excess capital, we will continue to return capital to our shareholders. We're pleased to announce a new $500 million share repurchase program this quarter. This follows the completion of our previous $500 million share program last year and brings a total commitment to $1 billion in share repurchases. To wrap things up, 2025 has been a milestone year for us. If our first decade was about proving that the super app model could work, then this past year was a critical proof point that we can scale this engine with durable growth and profitability. While we are proud of our progress, we recognize we are still in the early chapters of our long-term journey. The Grab that you see today is fundamentally different company than the one that went public 4 years ago. We have reached a stage where growth and profitability are no longer a trade-off. We are driving significant top-line expansion while maintaining strict discipline on our capital allocation. What is most meaningful to me as well is that our financial progress is now the engine for our wider mission. By generating robust cash flow, we are in a stronger position to deliver our triple bottom line. We are delivering sustainable value for our shareholders by building a profitable compounding business, enabling us to create positive societal impacts by expanding earnings opportunities for our partners, but also at the same time protecting the environment. We are more energized than ever to continue this work and keep growing the business for our users, our partners, and shareholders. Thank you for watching and listening to Anthony, Alex, and I. I will now turn it over to Ken Lek as we begin the Q&A session.
Peter, we now open the call to questions. And as a reminder to our audience, please submit your questions via investor.relations@grab.com. With that, our first question comes from the line of Pang Vit from Goldman Sachs, as well as Hong Han from CLSA. The question is about our EBITDA, 2028 EBITDA guidance. Question for management. You've provided a strong outlook of tripling EBITDA between 2025 and 2028. Could you outline the key assumptions by segment and what are the biggest drivers to this step up?
Let me take this one here, Hong Han and Pang. There's really two key themes if you really step back. And in the last 40 minutes, we've actually outlined what they are. The first is sustainable growth. You're seeing that momentum of the revenue growth that you're seeing in the business, and that translates to what you see in the guide, the 2026 guide, in terms of revenue, the 20 to 22%. And then also even gone beyond that to 2028, where you see that 20% revenue CAGR growth from 2025 to 2028. So that's the first theme. The second theme is operating leverage in the business and the cost structure. Now let's step back here. There's really, if you look at in terms of how we think about profitability, that $1.5 billion of EBITDA target that we're aiming for, there is four key things. The first thing is on-demand revenue. The on-demand engine is working. And you see that continued momentum in driving user growth at the top end of the funnel that we're seeing right now. Now, that is going to translate into also absolute margin expansion and absolute margin dollar in the business. We are driving costs down so we can lower the cost to serve in the business. That affordability that we're working on, so focused on, is working, and we're going to continue to extend that. But to do that and drive margin at the same time, you've got to drive also lowering our cost to serve. So we're going to go and continue to double down on driving that top line, but also lowering our cost to serve so that we can deliver margin improvement in both the deliveries and the mobility business. So that's the one first critical pillar that we're going to drive. The second one is around financial services. You're seeing that engine working now. You're seeing that loan book now continuing to scale. We clipped the $1 billion in terms of loan book. And what you're going to see is that as the business turns break even in the second half of 2026, it'll enter into a new inflection point. And you're going to see that profitability continuing to grow. We're very bullish in where financial service is going as we lower the credit costs also of that business. And the risk-adjusted return that you're seeing is already tracking above our cost of capital. So you've got the financial services segment and also the on-demand business working together to really lift that operating margin in the business at the same time. Now, the third and the fourth is really a combination of operating leverage in the business, which is the corporate cost out of the house. And you're seeing that corporate cost coming down. If you look at 2023, it was roughly about 17% as a percentage of revenue. In 2025, we've gone down to 11%. So you see a 600 basis points of margin improvement of that business. So as we continue to drive costs in the business, whether it's our cloud costs, whether it's the cost of funds, or just using more AI to drive productivity in the business, you are going to see that absolute margin improve overall as a business. So that's how you think about it. Two pillars, continuing to drive that growth across all our core segments of our business, drive operating leverage, and that generates the margin, continued absolute dollar improvement to that $1.5 billion.
Our second question and a related one comes from Venugopal from Bernstein. And this is a question for Peter as well. What prompted us to provide a 2028 guidance, as such long-term guidance is typically not common? How predictable is the business model? And is this all going to be driven by organic growth?
So Venu, yes, it's all organic growth. That's what we've given out here today. If you look at the strategy, it actually hasn't changed in terms of how we're going to continue that momentum. Just to earlier point, the previous question, we're continuing that momentum in the revenue side of the business. And we feel that the timing is right. The last time that we provided a 3-year guidance was back in September 2022. And now the business has changed. The business has continued to scale. We're seeing a momentum. It's at an inflection point. And we are seeing all the ingredients that we've been building over the last 2 years now are coming into action. And 2025 was a year demonstration of that. And we want to continue to extend that. But we also want to provide our investors a long-term financial roadmap. What are we heading for over the next 3 years? And really that acceleration of growth that we're seeing, we're going to continue to maintain that. We clipped over 50 million of MTUs today, and we think there is still a lot more MTUs that we can reach in Southeast Asia. If you look at the number of cities we've added in the last 4 years, we've added over 400 cities. Imagine that in Southeast Asia, we've added more than 400 cities. These are non-capital cities, and there are more cities that we want to go and enter and serve the Southeast Asians. So we want to continue to maintain that growth. But at the same time also, we know that we have to grow the profitability and the free cash flow conversion. So we've given up all ourselves as a management team, as well as Grab as a target to go for. And that is that $1.5 billion EBITDA that we want to reach in 2028 and the free cash flow conversion of our business. We're on the right. All the cylinders are firing and the engine is going, which is great to see. And 2025 was a testament. We're able to demonstrate we can do that. And now we're in 2026. We feel confident in the next 3 years.
All right, we'll move on to a few questions on Indonesia. The next question comes from Naveen Killa from UBS, as well as Pang Vit from Goldman Sachs. A question for Alex. Is there any update on Indonesia's proposal to lower ride-hailing commissions? And if implemented, how would this impact take rates and segment margins? And what levers do you have to offset that potential pressure?
Okay, thanks for this question, Naveen and Pang. This is actually a great opportunity to clarify because there's been a lot of speculation in the media about what might happen in Indonesia. So we can confirm that the government have not proposed any changes in commission caps. We're in close consultation with them. And we're aligned and committed to their ultimate goal, which is improving the welfare of drivers in Indonesia. So those of you that have been following closely will know that we have unveiled social security initiatives for our hardworking drivers, plus a Hari Raya bonus coming up as well. And we're able to use the technology that we've developed, particularly AI and a product called Ride Guide, to help them get more productive so that they can get more orders and earnings for every hour that they choose to work. We'll continue to do this because both ourselves and the government have aligned interests to develop a sustainable platform that operates reliably for our customers and affordably for our customers to enable us to continue to create and enhance livelihoods for driver partners and micro SMEs across Indonesia. And then the follow-up question on the margins, I think from Divya is coming up. So Ken, do you want to read the question?
Sure. So Divya asks a follow-up question in Indonesia. Also for Alex, could you provide updates on Grab's GMV growth and market share trends in Indonesia in the fourth quarter? Do you expect margins for Indonesia to be impacted by higher driver welfare costs in 2026?
Yes, Divya, thanks. So despite the macroeconomic headwinds, we have driven affordability as a key part of our strategy and the product-led strategy in Indonesia. So we've been able to improve our category leadership across all verticals in Indonesia. It's growing about in line with the overall group and faster than the market in Indonesia. So we've been able to demonstrate sustainable double-digit GMV growth for our on-demand segment. And we've expanded the profitability year on year. So in answer to your question, we do not expect margins to be impacted by the social programs that I just described because we're getting more operating leverage as we scale up in the country because of our scale. So probably the most important aspect of the results in the fourth quarter for Indonesia were the increased velocity in financial services for us in the country. The highlight was, of course, the IPO of Superbank in December, which came out now, I think, with a 1.8 billion market cap and was incredibly successful, 300 times oversubscribed with over 1 million shareholders. And I believe at this point, we've got more shareholders in Superbank than any other stock on the IDX. So that's just an indication of the potential of the market for financial services. And we're just getting going now with an increase in velocity to be expected in 2026.
Okay, with that, we now have a two-pronged question from Piyush Chowdhury from HSBC. We'll take the first question first before we pause for the second. So first question is for Anthony on our AV initiative. So Grab has done various partnerships in cutting-edge AV companies. Can you provide an update on the progress of your various pilots? And apart from Singapore, do you see commercial rollout in other ASEAN countries in the next 3 years?
Great question, Piyush. Well, Piyush, our long-term strategy is centered on a single goal of building supply resilience. We view AVs not as a replacement for our driver partners, but as a critical buffer to ensure 100% reliability. That is the key driver for customer retention, especially during peak hours or in underserved areas. You may actually have seen us make, as you talked about just now, small minority investments. Now, these position us in Southeast Asia in a way where we can have a geopolitical and technological hedge because we can partner global leaders across both US and China ecosystems, whether it's a WeRide or May Mobility from the States or Momenta, and even hardware leaders like Hesai in LiDAR. Now, this agnostic approach allows us to leverage this unique position we are in with the ability to take the best technology from the world to adapt it to specific nuances of Southeast Asian infra. Over the next 3 years, you asked, we see actually Singapore as our blueprint. You look at Air. Air is our first public AV shuttle service in Singapore's Punggol district. That's a great example. Air has covered over 25,000 kilometers with 0 safety critical incidents or near misses. This is the highest mileage recorded and the most data collected by any AV operator in Southeast Asia. Our in-house fleet operations tooling will also enable real-time alerting for AV issues, which allows our operations center to respond quickly to potential incidents. And most importantly, we strongly reiterate our commitment to transitioning our driver partners into new and emerging roles as we move towards a hybrid human and autonomous fleet. We are already retraining our strong Grab driver partners to form a pool of qualified safety operators during this pilot. They're part of our growing AV fleet operations ground team, which also comprises customer support and depot operations. And we do all this to ensure as we move to a hybrid fleet, we maintain our operational heart, while, as Peter just now shared, lowering our long-term cost per kilometer. We will, of course, continue to work hand in hand with regulators like Singapore's Ministry of Transport to collectively define the safety standards and operational frameworks that allow driverless transport to coexist safely with traditional traffic. Ultimately, we see this transition as a way to future-proof our platform and network, and we ensure that we can remain the most efficient marketplace as we lead Southeast Asia into its next chapter of mobility.
Thank you, Anthony. So second part of Piyush's question, it's a two-part question for Alex. How was the performance of the various new product initiatives you launched in 2025? And what are the key learnings from these rollouts? As for 2026, what new products could we potentially anticipate? So first part of the second question. The second part of the question is, I note that Grab's MTUs has grown 15% year over year to now cross over 50 million users as of the fourth quarter of 2025. Could you share with us your outlook for MTU as a percentage of ATU penetration over the coming years?
Thanks, Piyush. Yes, you're right. At the start of 2025, we did say that we would be focusing on user growth and frequency, and it was indeed a key driver of our growth acceleration in 2025. I remember 2 years ago, we were talking about Grab being used by 1 in 20 of the folks here in Southeast Asia. Now we're at 1 in 15, and I would make the same point. Although we're growing very fast and penetrating very fast, we're still just scratching the surface. There's lots of upside left in this young, dynamic region for Grab to continue to penetrate. So our GMV growth accelerated by 21% year on year, but the transaction growth, which is key, grew even faster at 24% year on year in this last fourth quarter. That MTU to annual transacting user penetration is at 37%, as Anthony said at the start of the presentation today. And that's an increase from last year. And ATUs, the overall base, has grown even further to 129 million users now. So the product strategy is working. We will continue. We updated the new product initiatives in deliveries when we last updated at the half year, contributed to about 1/3 of our GMV. On a full year basis, I can tell you that now is represented by almost half, so 46% year on year GMV growth from our new products. So a massive contribution. Just to summarize what the product strategy has been and what we will continue to focus on. So the laddered pricing strategy is working. Affordability drives a lot better frequency. So Saver gives us 1.5 higher frequency than the average. And the high value customers are here in Southeast Asia as well. Less price sensitive, looking for limo rides to airports, etc. So we'll continue to grow at the top end of the ladder, also allowing us to manage the margin mix very nicely, as you saw in the overall results. We like viral products for users. So we've been building viral products where usage brings in new users through the platform. So Group Order is a great example of that. We get to double the retention and frequency from Group Order that we get from the average. Family accounts is another example of that. And then Grab More, the cross-sell from food into Grab Mart, is also operating extremely well for us to help build long-term value. And then the last and probably the most important aspect is the focus on the merchants and their success. So now we've got a whole suite of integrated solutions, as I was describing earlier, that go from demand generation on delivery, dining in, loyalty as a service, all the way through to payments, fintech, lending, etc. We are the only provider in Southeast Asia that can bring all of those together for the merchants. And the more successful those merchants are with Grab, the more successful Grab will be in the long run as well. In the future, we're not only talking about penetration of MTUs into ATUs, but we're now increasingly inside Grab talking about daily usage. We want Grab to be embedded in the daily lives of people in Southeast Asia every single day. So the frequency of once per day is how we think about the challenge in 2026. And we're making good progress towards that. Thank you.
Next question comes from Alicia Yap from Citi. This is a 3-part question on our 3-year revenue guidance. So first part of the question, could you provide us with the breakdown by segments of how this will contribute to your revenue growth? Second part to the question, could you also provide color on deliveries EBITDA margin by 2028? And third part to the question, will you still achieve financial services break even by the second half of 2026? So all pointed questions, and this is a question for you, Peter.
Okay, hi Alicia. If you look at the top line, what you're going to see over the next 3 years is where the financial services of our business is going to be growing much faster than our on-demand. And that's just the products are just scaling. You got the banks now on fire, going really all out in building that loan book. We've clipped the $1 billion loan book. We expect to double that loan book by exiting 2026 and continue to increase from that. So with the banks continuing to increase their penetration in the marketplace, and also with some of the other products that they're coming up with, we expect that growth to continue to accelerate, outpacing the growth of our on-demand business. That's not to say that our on-demand business will also continue to grow, which there will be. If you look at what Alex has been sharing across the product portfolio of our deliveries business, we're seeing strong growth on our grocery business, which is growing 1.7 times faster than our food business. And that will continue to also to be maintained and sustained as we go into 2026 and beyond in the delivery segment. We still have work to do also in affordability. We're not stopping on affordability. There's still a lot of things that we want to do on the ride side of the house, as well as on the delivery side, that will continue to also fuel the momentum on the growth business of our on-demand. Margin, you'll see margin expansion, as I said earlier when Pang asked about the margin side. The on-demand business will continue to grow for both on-demand, but also you'll see the financial services margin continuing to grow faster than our on-demand business also, and also when it comes to the absolute margin versus our on-demand portfolios of our business. And then also we're continuing to double down on our advertising business at the same time to supplement and complement our on-demand business, which is really critical also as we continue to grow. I think there was one more question from Alicia, which I haven't answered. I've lost track. Did I?
FinTech break-even?
FinTech break-even, that's right. Alicia, I can tell you right now, second half 2026, it'll happen.
All right, thanks, Peter. So we're getting a couple of questions on AI from both Alicia from Citi as well as Naveen from UBS. So Anthony, a question for you. Given the rapid evolution of AI models and the increasing penetration of AI chatbots, what is management's view on the positioning of Grab's super app strategy in light of this? How does Grab anticipate potential shifts in user behavior and the use of AI chatbots as discovery funnels and ordering gateways, which could disrupt its services?
Great question, Naveen and Alicia. Look, we view the evolution of AI not as a threat to the super app model, but as a high velocity engine that will scale our model. Now, to address your point of disruption, we see three strategic pillars that strengthen our position rather than pose a threat. Let's talk about LLMs. LLMs are exceptional at discovery and digital commerce. We have now become embedded. We as Grab have now become embedded in the everyday lives of Southeast Asians. And this is the beauty of how we use and leverage this embedding. The hyper-local physical infrastructure that we've built by being embedded across Southeast Asia, it allows mobility, food delivery services to become our strong mode. And Grab has become the indispensable fulfillment partner. So LLMs can be a great channel, but we are the indispensable fulfillment partner. We own real-time mapping, the merchant relationships, and the fleet logistics across Southeast Asia. And these assets, a lot of them are physical, on-the-ground assets, are incredibly difficult to disintermediate. Number two, you mentioned earlier about search engines directing traffic. Now, our partnerships with OpenAI as their first lighthouse partner some time ago, and Anthropic aren't just for internal efficiency. They allow us to ensure that when a user asks a third-party AI, for example, how do I get home? Or what should I eat? Grab is the integrated fulfillment engine behind that answer. I would say the third part, now for users, they want depersonalization, they want efficiency. So we are deploying semantic search and generative AI to turn our super app into a personalized concierge, if you may. We aren't just waiting for search. we are leveraging the data we have, leveraging generative AI and the best foundational models to predict intent. For our ecosystem, with over 1,000 proprietary AI models, as Alex shared before, we're already powering merchants with our AI agent. We talked about Mai before. We're powering drivers with an AI ride guide that Alex talked about as a coach. We've dispatched over 90% of our rides are fully dispatched with AI, and we continue to improve credit underwriting with AI. This has directly translated into higher retention and improved unit economics. If you remember, from 2022 to 2024, headcount basically stayed flat, but revenues doubled. That's what we see. We've seen the power of AI. Ultimately, we continue to build the AI-led operating system for Southeast Asia. We're excited to showcase the next generation of these tools at our upcoming GrabX Product Day. So we hope to see all of you there.
Great. So the next question is actually on our new acquisition, Stash. As a reminder to the audience, we announced this morning that we're acquiring a digital investing platform, Stash, based in the US, which Alex shared more details on earlier. So two questions, one from Ranjan Sharma from JP Morgan and another from Venugopal from Bernstein. So firstly, could you share with us, management, some of the financial metrics of this business, including its burn, as well as near-term earnings? What did you pay for these assets on a valuation basis? And second question, what does this signal? Is it a platform that's meant to be rolled out in Asia, or is it a formal entry into the US market? Does our 2028 guidance include contributions from Stash? Question for you.
All right, lots of questions there. Let me just start. Our long-term strategy is very rooted in Southeast Asia. We still have a lot of work to do in Southeast Asia. It's our core markets, and there's still a lot of products and users that we want to touch with, whether it's across all our different segments of our business today. Now, why did we do Stash? It's really a unique asset. If you look at the trend of when we do acquisitions, if we looked at the last unique asset that we acquired was around supermarkets, the Giant, Everrise. We see Stash as a very unique asset with a few things. One is it's got a very strong IP. It's got a strong talent pool and a platform that we don't have today. If you look at financial services as a business, what do we have? We have a very strong payments. We have a strong lending business, which is continuing to scale. We have a big deposit base of 7 million customers on the deposit side, on the banking side of the house. What's missing? We don't have an investing platform today. And that's really critical for us as we continue to complete the full picture of financial services in Southeast Asia, or also in other parts of the market where Stash operates today. Now, it is a positive EBITDA business today. It is generating free cash flow positive. And we see this business generating $60 million in EBITDA in 2028. So it's an accretive business that we see. But really, it's important that we also serve our user base today, not only in extending loans, but also teaching them how to save. It's critical in terms of our mission for the underserved, especially on financial services. So we're very excited to have the Stash family joining us. We expect to close this transaction sometime in Q3 or Q4. It's a great team. We already have over 1 million customers that we're getting to serve, that they've continued to prove that their product works. And as they continue to build their product set out, they're going to continue to penetrate the US market, but also over time, we'll introduce the product here in Southeast Asia.
We're getting several questions now from various analysts on our grocery strategy. So notably questions from Jiong from Barclays, Divya from MS, Wei from Mizuho, and Sachin from Bank of America. This is likely a question for you, Alex. Can you provide us with an update on our grocery strategy and recent growth trends? What changes are you seeing in the competitive landscape across Southeast Asia, and how do you plan to invest capital into this vertical?
Okay, thanks. So our most upvoted question. Well, first of all, let me start with the market opportunity. In ASEAN, the modern retail penetration is less than 40% of the overall grocery market. And then online grocery penetration is even lower at less than 3% in the majority of our markets. That compares with much higher numbers in US, China, UK of 15, 20.
All right. 我不知道现在还有没有人在直播里面 Let me just see it real quick. 300个人 OK 因为I gotta go. Yeah, 因为我开头跟大家说我9点需要走，不过现在已经呢9点11了 ，cause or else I'm gonna miss my train. Yeah, 所以还没有看完的部分呢 ，That's OK， 因为应该已经剩没几题。to be honest， 这个是我看过呢最久的这个 you know 这个 earnings call， 因为他们基本上有 3-year roadmap。对不对？然后他们那个 CEO、CFO 都各占了15分钟，那45分钟的前面的 presentation 是很久了，因为通常他们只会跟你说啊，今年怎么样，明年怎么样，blah blah blah blah，那个前面应该20分钟结束，但他们拖了45分钟，因为他们就很多东西要讲嘛，嘛金搞威啦，所以他们讲了其实蛮多新的东西 ，yeah， 所以我在开始前带你们看到这个3-year outlook， 我就有蛮震惊说他们有推出这个东西的，所以事情是这样，我现在要去赶高铁，然后因为明天本来就有直播嘛，礼拜5本来就有直播嘛，对不对？所以明天的直播呢，我再把今天我们看的东西呢总结一次，然后再给大家。比如说他上次有说，刚那个 CFO 有说3年前的 outlook， 那我们就可以来说，2025有没有达标啊？因为他2022的时候提供了3年的 outlook 嘛，现在有没有达标？不知道，我们到时候来看一下。然后我们就可以来推敲说，他这个3年的 outlook 2028年可不可以达标啊之类的 ，yeah。然后刚才有问到那个 Indonesia， 就很多人关注的那一点Indonesia 说要把司机的这个抽成降低到 10%， 就你在平台最多只能抽司机的 10%， 就这样 ，yeah。但是刚刚那个 Alex 说，现在还没有这样子确认。那就像我最一开始跟大家分享的那个可能2个月前的，我忘记了。就算他真的抽成要到 10%， 那也是 Grab 会最后死掉，因为 Grab 是唯一一个有盈利的公司。那些没有盈利的公司呢，这个 cap 加上去的会死得比 Grab 更快。所以最后呢 ，Grab 在这个地区呢，我觉得这是个 net win。OK，lose。不过如果最后只剩 Grab 的话，那是个 net win。OK， 所以 again 这些重点。包括今天 Grab 的股价是跌还是涨？这虽然这不是太重要，不过 overall 你可以看到 management 他们还蛮 having fun， 重点是 having fun， 因为 Peter 是跟你讲说，有那个今年会不会有 financial 的部门转正？他一再的重申这一点，然后2026的后半年 you are gonna see that， 他说 you are gonna see that，yeah。所以我很难想象一个剧本是他们后半年没有转正，然后 Peter 的脸会被打得多肿。我很难想象，他都跟你说 you are gonna see that 了，然后最后没有达到，那不是很奇怪吗？所以 they are very very confident from the earnings call， 所以我不觉得有 that bad。OK 如果今天股价涨或跌了 ，that's fine， 我就跟大家说。我其实买了15个 call 啦，15个 call 没有很多啦不过我就跟大家分享我做了什么。我买了15个 call 是明年会到期的所以我就觉得说，今年 Grab 会不错所以我就是买了15个 call。Of course， 我不是 financial advisor， 我就是跟你分享说我做了什么。有可能这15个 call 呢，到时候都会打水漂。But that's fine， 因为15个 call 其实也没有多少錢，所以就跟大家分享啦，好吧？这样 Grab 的背心要脱掉，因为我真的要去赶高铁我穿这件去的话会被笑死，所以 guys。Appreciate you guys coming， 因为7点半的直播呢，事实上是只有疯子才会参加的恭喜你成为今天的疯子 ，So appreciate you guys, love you guys， 然后我们就明天的直播再来做一个总结。Alright guys, take care, have a great day, see you later, bye bye.